Happy Wednesday, everybody. And as we wait for David Gazarian from the IQ Mortgage to join us, just wanted to remind you that today's Wednesday, and as always, we're talking about what's going on in the mortgage world and the real estate market. Today, we will be discussing with David, who is joining us in a second, the questions such as the new FHA program with no down payment at all. And we're going to get all of the details on this program from David. Also, we're going to discuss what hi Gordon, and how that is going to save money to the consumers on lowering the FHA insurance. Good morning, David. How are you?
Alexandra, good morning. How are you doing?
Doing great. We're
good morning,
just
Gordon.
Talking. Good morning. So I was just saying that the things that we would like for you to update us on. And number one is the brand new program that you've been offering to the consumers, the FHA with no down payment. We can't wait to hear the details on those.
We just got this really cool lender. The account executive came in there and he told us about this program, and it was last Friday. We have not closed the loan yet. It was literally, but I've gotten so much buzz. I did a big email blast to a bunch of realtors, and literally I keep getting emails. David, send me flyers, because it really is a cool program.
Tell us all about it.
So I'm excited every time. Yeah. So every time you can solve one of the big three components of your mortgage, it's a big win. It's a big deal, which means some people will be able to buy a home where in the past they weren't. So going back, big three ingredients: CIA, credit, income, assets. This program, FHA, let's talk about FHA, what it really is. FHA is a 3.5% down payment program, stands for Federal Housing Administration. It's a government loan. Now, 3.5% is pretty minimum down payment, right? You would agree. So what it really means is, in the past, you would put 3.5% yourself, and the government would finance the 96.5%. Now, if you don't have the 3.5%, we can finance that too. There are what's called down payment assistance programs that are offered by Nevada Housing Division. I'm not knocking on them. They help a lot of really good families to get into homes, but their credit requirement is 640 most of the time. Well, or 660, 640, I think. With this program, our credit requirement is 600, which means your credit is really, it's lower than conventional minimum. 600 is, I would say, 95% of our clientele. I mean, you do get the 560s and 480s, but that's quite rare. And even if someone has 560, you can bump up with pay down a credit, whatever, maybe get on a payment plan, do some positive things on the credit and improve your credit. You go above 600. That's not asking for much. So if we have a program that goes down to 600, and the asset, right? Hey, Raul, and the asset requirement is 0, which means the same lender. This is what I love about this. The underwriter that's going to underwrite the first main FHA loan, that's the person that underwrites the second loan. So now you have a first and a second lent by the same lender, which means it can be done concurrently and close very quickly. Technically is a 0 down loan. I will wait for you to ask me what the rates are on that, but ultimately that's how it works. You finance a first and a second from the same lender, close simultaneously, much quicker, and basically out of your CIA, credit is taken care of, assets is taken care of. All we really need is for your person to have income. And Raul, I know you do a lot of property management. You guys don't rent anything out to tenants unless you check their income. And obviously your tenants have income. So technically all of your tenants, if they feel like buying a home, a lot of them say, well, I have bad credit, or I don't have down payment. I have that problem fixed with the 0 down FHA loan. I'm done.
Okay. So, the question is coming. What are the rates?
All right.
What are the rates? What are the costs? Does it cost a person to go through this program? Is going to cost more than a regular FHA? Is it double the closing costs? talk to us about how much.
Okay, so first loan is a regular FHA loan, which means it's not like an FHA loan, but it's like a portfolio or alternative. It's actually an FHA loan. It's going to be insured by the government. So just like you would have your 3.5% and qualify for an FHA loan. So that's pretty cool, which means in the future, you will qualify for what's called a streamlined refinance once rates drop. And that's almost like a free refinance. So having an FHA sets you up for that perfect, no cost, no income verification, no appraisal, streamlined refinance in the future. You can ask me about that too.
It's coming.
I'm in a good mood today. But yeah, but basically, so the good thing about getting an FHA loan is you don't have to pay us any commission. Most of our commission is going to come from the lender. We prefer not to charge clients any origination if the bank will pay us for it. Now, good alternative loans out there, they don't pay us commission. Now we have to ask the client for origination. This is a loan where the client has no money. So, and basically, if your client pays $500 for the appraisal, and if you, and I know you can, but if the agent gets closing costs from the seller, literally the client can buy a home with zero money down. Does that make sense?
Yes, it makes perfect sense.
Yeah.
So
down payment's taken care of.
We understand that first loan is going to be the regular FHA, so whatever the going FHA rate will be. Now, talk to me about the second loan. So this 3.5% that needs to be to be there for the down payment. What are the terms?
Yes. So it is so let's think of the first loan. First loan, let's say FHA, what's it today? Like 6.8, 6.9%. Whatever we lock the first, the second is plus 2%. So if I lock the first, again, it's with the same bank. If I
David, I'm sorry, maybe it's only for me, but you froze for a second on the very crucial moment. I hope it's only for me, but
okay.
So you said whatever we lock the first one at, the second one is going to be what?
Yes, plus 2%. Mm-hmm. So if I lock this, for the sake of the example, let's say if I lock the first rate at 6.8, the second's going to be at 8.8. So plus 2% of whatever the first loan is, right? So let's do a quick example because I've got my software up here. Not an example per se, because let's tell our viewers what the max purchase price is going to be, because we do have some realtors watching as well. Raul and Gordon watch, so, and I'm sure you want to know. So max loan amount in Clark County for FHA is $492,500.
Clark County, Nevada. So Clark County, Nevada, because I know there will be a lot of realtors watching from the other states. So we're talking about Clark County, Nevada, guys.
Yes. Clark County, Nevada. Yes. And obviously reach out. I'll take a look at your Leo. What's up, buddy? Your FHA limits are much higher. So let's take our 492,500, which is our 96.5%. That's the body of our main loan. And if this is the 96.5%, our purchase price is $510,000. This is pretty remarkable for Las Vegas. So you can get a house for $510,000 and literally spend zero out of your pocket as long as the seller agrees to pay for your closing costs. It's remarkable. So obviously, work needs to get done. Understand, we still need to collect your documents. We'll show it to the lender, make sure you're solid. We don't just spit out the pre-approval letters. We'll do the diligence, make sure you're solid. But you get a $510,000 home with putting zero down. This is not LA. You're welcome, Leo. You guys have these types of loans all day in Los Angeles. We don't. So it's remarkable, and I think we're going to put a bunch of people in homes now. It's going to become available, affordable.
So I have a few more questions on this program. Is there any prepayment penalty? How do we pay this the second loan off? Is it supposed to be, like, is it paid in parallel with the first one? What's going on? Like, is there any penalty for selling the house?
No penalty, because again, this is a government loan, which means a prepayment penalty would be illegal. There are no prepayment penalties on owner-occupied homes. I would love for people to know that there are no prepayment penalties on owner-occupied homes, like, period. Now, the second loan is amortized over 10 years, 120 months. So if I were to stick with my large example, $510,000 purchase price, 3.5%, 3.5% down payment assistance, which would be the second loan, would be $17,850. And let's say I'm locking this today at 6.8%, then my payment for that would be $228.
$228.
So for $228 more
for
the
how long?
loan.
10 years?
10 years, yes. You'll pay this off in 10 years. So basically, if you don't have the minimum 3.5% down for $228 a month, you can finance that small and have a first and a second. And this, in my opinion, is beautiful. You could buy a $500,000 home and become a homeowner.
Now tell me, is the interest rate, as the person who is a licensed CPA as well, is the interest on the second loan just as much deductible on your taxes as the interest on the original FHA? So you were deducting that.
I'm not a CPA. I'm not a CPA. I'm not even a registered tax preparer. I used to be a registered tax preparer with the IRS. I let that license go. But yes, I do know with certainty that both of these interests paid for your first home are deductible.
Okay, and one more time, awesome. We're not doing the closing costs for the client, correct? Client is not, even though there are two loans being originated, the closing costs are still the same, or they're slightly higher, or what is the number there?
Closing costs are not slightly higher. There's no additional closing costs because of this. This is a simple second loan tackled onto the first one. So you're going to sign two sets of loan docs. One will be amortized over 360 months. The other one will be amortized over 120 months. You're going to pay $228 for it. And that's as simple as that. If you want to refinance a day out of closing, like literally the next day of buying this house, you can if you want to. You can pay it off. There's no restrictions.
No penalty. Excellent.
The goal is for you and I to put people into homes with zero money out of their pocket, literally zero money. They should be able to just pay the appraisal, or maybe we could have the seller pay the appraisal. I don't know. But if the seller pays for closing costs and we can finance the down payment, the 3.5%, then we can place someone into a home with zero money down. I haven't done very many in my life, but it's such a great feeling when someone has lost hope, they don't think they can buy a home, and you put them in a home with zero money out of pocket. I've done some. It's a very, very gratifying feeling.
Thank you, guys. I see the comments saying amazing. So is there any special requirement that is going to be in concerns to the property, or any FHA eligible property shall be eligible for this loan?
Any FHA eligible property should be eligible, even like I believe they do mobile homes. I'll have to check, but mostly townhomes, single family homes. This goes without saying. If you want to get a home, finance a condo with FHA financing, then before making that offer, make sure that that condo is approved by the FHA. There's a special website. The government does keep a list of all the FHA approved condos. Call me, I'll check for you. I sent you guys, we actually extracted that list into a spreadsheet, sent it to our partner agents. You guys should have that. But again, condos are a bit different, but any kind of home that's FHA approved.
Absolutely.
Sorry about these long
answers. No. We want to know all of the details. We want to know all of the details. So it sounds like these days FHA is really trying to help the consumer to get into a property and doing their best, because not that long ago, FHA lowered the mortgage insurance. Talk to me about that, how much money it is saving for the consumer, and how does it benefit the consumer?
So every time you put a less than, with FHA, there's this thing called mortgage insurance. With conventionals, I guess I should mention that if you get a conventional loan, you put 20% down, there is no mortgage insurance. That's not the case with FHA. You could put 90% down. You're still going to have mortgage insurance with the FHA. In the past, mortgage insurance used to be from 0.8 to 0.85% of the loan amount per year. And this was expensive. So this was a very delicate balance that we would have to do for clients. So the rates with FHA were lower, but PMI mortgage insurance was higher. And a lot of times FHA would end up costing more than the conventional loan. Now, FHA, this month actually, the FHA lowered its mortgage insurance threshold. Now, if you put the 3.5% down, the mortgage insurance is only 0.55% of your loan amount, which is significant. It's a huge decrease, and that made FHAs much more attractive to me. We honestly flipped our pipeline to more FHA loans because we're getting better loans, more affordable loans for our clients. They will be able to refinance, get a streamlined refi in the future, zero cost. Again, I think it's worthy of talking about streamlined refi. So
I would like to ask you to actually calculate and make it easier on everybody. We just talked about the loan amount of $492,800. So can you give us the numbers, what the mortgage insurance used to be and what it became, just to compare like the two numbers? If it was 0.85,
of course,
because I know you're in front of the computer and I'm just trying to hold my phone still so people don't get nauseous.
Okay, let's say we're getting the maximum loan amount in Clark County, Nevada, which is $492,500. In the past, let's say back in February, a month ago, your PMI of 85 basis points would cost you $354. That's like a lot of money. Per month.
300. Yeah, once again, $382. 54.
54. Yeah. That's the 85 basis points of $492,500. Now, if I change this number by only $229, so there's savings of $130. That's very, very significant. That's like a make or break for a lot of people. Savings of $130.
Yeah, this is
$130. Yeah, that's significant.
This is $130 where FHA you can spend somewhere else.
Yes, of course. So you could borrow more. Let's say your income only allows you to go to 300,000 qualification. Now all of a sudden it's 330, 340. Okay. Does that make sense? Now you can get a better property. So FHA just became a much better product for our clients. Whereas Fannie Mae and the Fed are trying to make homes unaffordable, FHA just made homes affordable for our clients, and we'll take any good news.
And one more time, you said that now, would this lower mortgage insurance apply to the no down payment FHA loan that you just mentioned?
Of course it has to, because they're both FHA loans. The no down payment loan is essentially is you're financing the second 3.5%. I apologize. I forgot to put my phone in focus again. Did it again. Yeah. So the second loan is financed, but the first loan is a vanilla FHA loan. It doesn't change. So all the characteristics of an FHA loan still remain.
Excellent. So these are the two good news that came from the FHA. We still don't have the news from the Feds, not till 11 today, correct?
They say 2 p.m. Eastern, which is going to be 5 o'clock.
No, which is going to be 11 a.m. our time.
Oh,
no?
Yeah,
11 a.m.
11
Yeah,
a.m. our
11
time.
a.m.
Yeah,
our
yeah.
time. So we're waiting for that. And obviously,
Good news.
obviously, something that that is on yours and my agenda this week is going to be what kind of loans are available for the international citizens. Or if we're talking about Canadian citizens, if we're talking about people who do not have a either credit or if they don't have the Social Security. And I know that these are
Immigration status.
two, yes, these are two separate cases. So first, I would like you to probably answer this question. If I don't have a credit history at all, because the specifics of your and my work is that we work with a lot of people who have immigrated and who received the Social Security probably like a month ago. And these people
Right.
have no credit history. Now, is it possible to get a loan, to get a mortgage if you don't have any credit history?
Not if you're in the United States, unless you're looking for, say, something called hard money loan, private money loan. If you're looking for a type of a mortgage that goes through appraisal and underwriting process, some kind of credit is required if you live in the United States. Oh, there you go. You've got someone that wants to help with credit. Awesome. Send us your information.
Absolutely.
And as far as, yeah, and as far as if you live in overseas, you're a national of a different country, you're a citizen of a different country, you cannot have U.S. credit, okay? By definition, you don't have a Social Security number. You don't even live in the U.S. So there's the program called Foreign National Program. You could do that with 25-30% down, easy. I've done many. We do have clients that come acquire homes, rent them out, and go back where they came from, and basically they own rental homes in U.S. Yes.
Okay, and now talk to me about the people who are coming to United States with H-1B visas, those visa holders that are actually getting the Social Security issued to them, like are the H-1B visa holders eligible for mortgage?
Okay, dumb it down for me. H-1B, is that
This is the work
business
visa.
visa?
This is the work visa. So, for example, all of our Cirque du Soleil artists, our international professors, any kind of a talented individual that is actually pulled from a foreign country on a contract to work in the United States.
Fine. You could get a regular mortgage. You don't have to do anything fancy. Very simple FHA conventional government loans will work for you.
Now, do we still require 2 years of tax returns from those people, or for the citizens like Canadian citizens, there are programs where we can actually use their the Canadian tax returns and the equivalent of the FICO score of the Canadian?
No. I'm not aware of any loan program, and I'm aware of a lot of loan programs. I'm not aware of anything that allows you to use your foreign taxes, foreign credit in lieu of a U.S. All we need to do is treat that as a rental property. You're not living here. That's not your home. It's a rental investment, basically cash flow generating type of business loan, right? That you're financing something, you're going to rent that out, and the only income that the bank really cares for is the rental income the property is going to generate. They really don't care what you have going on in your country.
So, but what if we have the...
That's not to be confused with H-1B.
Yes,
That's you kind of put them with the same paragraph.
That's why I wanted to. That's why I wanted to clarify with the H-1B. So H-1B is a foreign individual who is not a resident of the United States, who is not a citizen of the United States. This is just the individual who holds the H-1B visa, and they're eligible for the loans. Do we have to have 2 years of tax returns for them?
Yes, because now they're in the U.S. Now they're working in the U.S. They have a legal permit to work. They have a social security number, which means they should have some kind of a credit history built. And yes, they need to have taxes 2 years. Now, if you work for a company, let's say you just came 6 months ago and you work in the US, in some select cases, in the past, we have been able to verify their employment overseas. This is pretty cool, where someone comes in, they don't have 2 years of US employment, but if they're in the same line of work, if all checks make sense, we have verified employment with overseas companies, and that has served the 2-year purpose, verification purpose, yes.
Excellent. And David, one more thing that I happen to discuss with my clients a lot this week is, why is it important for the person who is looking to obtain a loan to actually sit down with the loan officer and get a breakdown of different programs and actually run their profile for the option of 3-2-1, 2-1, 5-year ARM, 7-year ARM, FHA, conventional? Like, why is it important for people? Because some people are saying that, oh, if it's not conventional, I'm not going for it. Or like, I thought that conventional is the best thing in the world, so I'm not going for anything else. Why is it important to sit down and just go through the numbers?
Well, because it's going to be the biggest acquisition of your life most of the time. Unless you're extremely wealthy, then the home is the biggest acquisition. It's going to be the biggest bill you pay every month, and you want to an extent, educate yourselves. Now, I have taken this to really crazy levels, and I have built my own calculators. I really, really drill down mortgage numbers. I really thought people would be more interested in that, but they're really not. So, but most people need to have some knowledge of financial, of what the differences are. We have so many different programs that we can build different scenarios side by side. The minimum down, zero down, FHA, conventional, God knows it, ARM, if you please, and see what the difference is. Ask me all the questions your heart desires. Let's talk about your tax deductions. And what kind of implications that'll have on how much tax you pay to Uncle Sam or how much refund you get, all that, right? Let's talk about when you'll refinance. Let's talk about I talk about the 6 principles of home ownership. Let's talk about that. I get really excited when someone wants to talk about more than just monthly payment.
Absolutely, but I think that monthly payment is a great start because it is important. Like, you can't skip over the monthly payment, correct? And to go back to the streamline refinance, talk to us about the streamline refinance, how it is going to affect the monthly payment, and how you can refinance your loan. At which point it makes sense to refinance. Like, what should be the difference between the going rate and the current rate for you to actually, so it makes sense to refinance?
So when it comes to streamline, streamline is a feature that's only available to what we call govies, government loans, which is FHA and VA. Streamline option is not available to conventional loans. Okay, now what is Streamline? Streamline is, from the government's perspective, if they give you, let's say, a mortgage at 6.8%, they underwrote your loan, they got an appraisal, they know how much your home is worth, they looked at your pay stubs and they verified your income, and they underwrote this loan at 6.8%. If you reduce your rate by half a point, so you get a 6.3 or lower interest rate, from the government's perspective, you're improving your financial situation. I mean, if they give you a rate at 6.8, they're going to be happier that you save more money and get a cheaper loan. Replace the 6.8 with 6.3 or 6 or 5. So that by default makes them, they made the streamline refinance option, which is you don't need to get an appraisal for the home. We don't need to verify income. If you qualified, your income was verified at 6.8, you're going to be okay at 6.3. So it's a reduced documentation refinance, which cuts on time, cuts on cost. Streamlined refinances are much, much cheaper, faster, and if you get this, again, bringing this back to the zero down loan, you are setting yourself up for a really nice streamlined refi in the future when rates drop.
So
really hope
one more time. So to be eligible for the streamlined refinance, so you have to have a difference between the going rate and the existing rate of the loan in order to apply for the
half a point.
At least half a point or more, correct?
At least half a point. Yes.
Excellent.
Correct.
So it is available for the FHA and VA loans when the rates drop.
Yes.
And it doesn't cost you.
Mm-hmm.
It doesn't cost you anything, or it is a minimal cost to it.
Well, there's going to be maybe an underwriting cost. There's going to be escrow cost because escrow is still involved. You may have some taxes, recording fees, and that, but taxes, insurance are minimal when you already have a kitty account. Like, you know, when you purchase a home, you need to set aside 14 months of homeowners insurance, 6 months of property taxes. When you refinance, your lender has a bunch of that already built. So especially if you refi with the same lender, we try to keep it with the same lender. Let's say we close a loan with UWM, we're going to refi with UWM. So there's no additional tax and insurance because they have that already. All they're doing is redoing that loan to 6.3, much, much reduced. Is there a cost? Yes. It's probably, I don't know, 40-50% less than a regular refi would cost.
Excellent. And for those who have conventional loans, they do have a different option, which is recasting. I know it is not available on all of the loans. It's not always free. Some loans have free. Some loans you have to pay for it. But would you tell us about recasting a little bit? I'm sorry, I'm throwing all of those curveballs at you today.
Recast is a very, very different beast. Recast means that I don't know. Let me explain. I don't know if this is a lender to lender. It's a conventional thing. I've never come across a recast for FHAs, but technically what it is, let's understand, when we get a fixed 30-year mortgage, right, in 2023, this mortgage will be paid off in 2053. What if you send them a big check? What if you send them a 50% check, a $200,000 check? What happens is your end date comes closer. So instead of 2053, you may be done in 2040 or in 2030. You just made a big chunk of payment, which brought your end date, but your monthly payments with fixed mortgages remain the same. Your monthly payments will never change. That's I guess the significant difference between a 30-year fixed mortgage and a line of credit, because line of credit is very much depends on your outstanding balance. Does that make sense? I think we need to clarify the difference. With fixed mortgages, your payments do not change. Now, once you do a recast, what you tell the bank is, guys, I'm going to do a big payment. I need you to re-amortize my loan. I don't want you to bring the end date back. I want you to, this new loan amount, this lowered loan amount, I want you to recast over 30 years or 27 years, whatever I have left, and my payment's going to drop significantly. It's not a refinance. There are no closing costs. You do this with your servicer. They send you a package of documents. You read that, get it notarized, send it back to them. They re-amortize. So instead of bringing your 30-year mortgage down to like 16 years or 12 years, it remains the same, whatever you have left, but the balance goes down and your monthly payment goes down. You should be able to do this. They have restrictions, I think, once a year, and you have to make more than $10,000 payment, and your savings have to be more than $100. They have thresholds, but those thresholds are
rules.
There
are rules and there are requirements to those. And guys, like a lot of people are telling me, oh, like I don't count for it because I am not going to buy a lottery. I'm not going to win a lottery. No, guys, like the chances are you're not going to win a lottery, but what is going to happen if you own more than one property, and if you decide to sell one and you need to, like you decide to do something with the money, this is one of the options that you can do. You can take part of that of those proceeds and recast your conventional loan. Now, in order to do so, you do need to talk to your original lender or your servicer, whoever is servicing your loan, and you'll figure out, oh, hi, Michelle. Ceci is here watching us from a cruise, I believe. And so in order to recast, you need to contact your original lender, your servicer, and talk to them. What does it take to recast? Because there could be terms from your lender. It could be minimal amount, and it could be a certain number of times per year that you can do it. You can't do it every single month.
No.
Excellent.
You shouldn't.
And if you have extra money, you can buy another property.
Yes.
Yes, but this is something that Ceci needs to know. Ceci, we're just letting you know that you can watch this video later on in the recording where we're talking about the new FHA program with no down payment, with zero down payment, where you can get a first and the second loan. So, David, anything else, any other news you have for us from this week?
I want to talk about something.
Great.
I want to get your permission to talk about something. I don't know how much you'll like that, but here's something I've been hearing recently. In my opinion, the rental value, I think people need to hear this. Rental rents haven't gone up as quickly as they probably should have. There's a big gap between owning and renting in Las Vegas. Now, tenants don't agree with you. They're like, rent is really expensive. I agree, because it's inflation. Everything's gotten expensive, and your landlord usually increases rent between 3 and 4% in Clark County. That there's been a study, I've seen it. So Clark County rent has gone up 3 to 4%, which means rent, we call it 100% interest goes to your landlord, doesn't get you any wealth, doesn't create anything. The only thing rent does, and it's hard to argue with, is it's cheaper. About, on an average $500,000 home, your rent's probably going to be between $400 and $600 cheaper per month. So this is
at this moment with these rates we're talking about, correct?
Moment at this rates. But here's what I want to talk about. Here's what I want to, because rates are high. Yes. So I've had clients that were like, David, I want to rent. I'm saving $400. Okay. So I did the numbers. I'm like, why would anyone ever own a home? I'm curious, because again, I drill down the numbers. I'm very curious, and I don't think we do a good enough job explaining numbers to people. I did a spreadsheet, and you know I have my calculator. So here's what happens. If you assume properties appreciate 2% per year, and this is a very, very safe number, because property should appreciate at least the rate of inflation, which is 3 to 4%. Properties have appreciated in Las Vegas 7 to 10% for the last decade. If you assume a 2% appreciation for properties, I calculated rent goes up 3% every year. You are ahead for the first 3 years. You are saving money renting for the first 3 years. Year 4, your equity built up. Understand, property appreciates, you pay down your principal. On year 4, you have a lot more. You have earned more than you have saved. So your earnings, your equity buildup has exceeded your savings. This is important to understand, because there's so many gurus that say you should rent and invest your money somewhere else. And here I am saying, no, long term, you're going to lose if you pay 3 years renting, 4 years renting. You're close to $80,000 you've paid to your landlord. 4th year, you've got about $4,000 to $6,000 more in equity, which means you have like close to $86,000 of principal equity built. That's your money. That's your net worth. So for the first 3 years, you're saving renting, but for the rest of your life, you have zero. If you own something, you're building crazy wealth. And I think we need to do a better job explaining these numbers, because people are making these decisions without really basing. I think people are basing their decisions on feelings rather than knowledge and math Math is important.
And I agree with you. I would say that real estate is a long-term game. Of course, we all watch TV. We all watch those Property Brothers, whatever, flippers. That's all cute and fancy, but this is all for the show. What happens in reality? In reality, you invest long-term, and this is the conversation that I have a lot with my first-time home buyers, with the newer generations who are coming into the real estate game. And a lot of times they tell me, oh, you know, like we were dreaming of this home, but this is not what we were dreaming about. This is way smaller. This is not as nice. This is not as new. And I keep on telling people that, guys, the main thing is to make your first step, to invest into your first property, and to start creating this equity in your home. Because it might not, your first purchase might not be your dream home. It might not be your dream location. It might not be your dream square footage or your dream backyard. But what you do, you're moving into a piggy bank. And that's the association that I always try to apply to my customers. I'm like, think about it as a piggy bank. And every month, part of your, of course, not the entire mortgage payment is going to go towards your equity, but part of it is going to go towards your equity. And it's like months after months after months, you're going to put a few dollars into your, you know, like a few $100s into your pocket. And one day, maybe it's going to be a year from the day you bought the house, maybe 2 years, you will be able to come out. And a lot of times what people forget about is not only the appreciation, the real estate property appreciation, but the fact that when you sell your primary residence, you get $250,000 of equity tax-free for a single person, and $500,000 free tax-free gains for a married couple for the primary residence that you occupied for 2 years and 1 day. So this is not only the equity that you're creating, this is not only the equity that you're gaining through the growth of the real estate market, but it is also a tax-free gain that you're going to collect, and that might be enough for you in 2 years to enter into a new level of a property that is going to take you closer to your dream home. And you might be 2 or 3 properties away from your dream home, but as long as you start this journey as soon as you can, you will be closer to your dream home, way closer. And I'm super proud of a lot of my clients who are doing it and who are, you know, I want to tell you this story. Like there is this lady, and she came to me. She's a school teacher. She works for the Clark County School District, and I want to say she was around 36 or 38 when we met, and she was shopping for her first home, and then she told me how scared she was because she lived through all her life, ever since she went to college, she lived with roommates, and she's like, and she was a roommate in somebody's house, and her bill was, I think, like $650 at that time. Like, and she said, this is all I pay, and all of my utilities are included. And she was so scared that she's going to have this house with 3 bedrooms, and she's going to take on the responsibility. And at that time, I think her payment was like $1,700 for the house that she was getting. So, and she had this huge fear, and she's like, I'm going to, and we have this term at work that is called the payment shock. When you go from $650 to $1,700 a month, that's a huge leap. And a huge difference between the two payments. So, but she made it. She made it, and I asked her, why don't you get the roommates? I'm like, why don't you be the one with the roommates? I'm like, you're comfortable living with the roommates. I'm like, why don't you get the two roommates? So guess what she did? She got two roommates at $650 each. So her mortgage payment is $1,700, and she's getting $1,300 from her roommate. Now, her monthly expense on her property is still around $650 because she's got the utilities and HOA. But now she's spending very much the same money, collecting $650 from two roommates, but she's creating her own wealth. She's putting this money and investing that money into her own house. And right now, she's extremely happy, and she's like, why? She came to me and she's like, why have I not done it earlier?
I know why. She didn't have the information. She didn't have the right advice. And you did the work. You went through the work of education and explaining, and she saw the light.
Yep, and I'm absolutely happy.
It's our job to educate and explain clients.
Absolutely.
It's our job. And a lot of people, we don't do our job a lot of times. So it's our job to educate, to impart with the knowledge that we have. It's that basic.
And I want to stress on something is that, yes, we spent years to gain this knowledge, and we don't expect anybody to know the same. And of course, there are people who know the same, that have the same amount of knowledge, and that maybe even more, they know more than David and I together. But we're here, guys, and we're here to spend our time. We are here to share our knowledge, and we're here to help you gain this knowledge and to break it down for you. And yes, sometimes our consultations, I just had an hour-and-a-half consultation yesterday, and my first-time home buyer, she was laughing, and I told her, well, she said, I took a piece of paper out to make notes. She's like, and I'm on the third piece of paper now. She's like, and I can't stop writing all the things that I need to know before I buy the house. And I told her, wait till you talk to David. And I'm like, I hope you have 5 pieces of paper with you, because it's going to be just as informative as, as the real estate market consultation. But people are happy. I know that what we're doing it for people, and I know that they're happy to hear it, and they're happy that they have you and I to share this knowledge and to guide them through the process, because it could seem like a very overwhelming process for a lot of people, because you guys don't go through it every single day, but we do. We travel this path hundreds and hundreds of times, like hundreds of times a month. We travel this path with our clients, and we're happy to sit down, we're happy to invest our time and to tell you, to break down the process and to guide you through this process. And that's what we're here for.
Yes. I'm here.
And thank you.
I agree. I'm with you.
Thank you for your time, and for the time of your team, and for taking care of our clients.
Thank you, Alexandra. Thank you. Yeah. Think of more questions for me so I can prepare for them. This was a very beautiful line of questions, and I think it helped. Hopefully it helped some people. I hope it was informative. Our job as lenders is to inform clients, not educate, really. Most of my clients are way more educated than I am. I don't educate. I just let them know what I know. And it's the same with agents. We impart. I blasted out the 0 down to 1,000 agents, and I got so many responses. David, this is awesome. I'm going to do a video. Send me a flyer. Got a referral literally. Got this funny, this agent called me. She was so cool. She works with another loan officer, and the loan officer had just finished pre-approving this client. And she goes like, David, as soon as I got the pre-approval letter, I got your video about the zero down. I want you to pre-approve my client. So we got that. It's so interesting. That's because now we're offering something better for the client to help their financial. It's cool. It's gratifying.
Absolutely. And it is important, and this is like good, circling back to why I tell people that it is important to sit down with the loan officer, because literally months ago there was no such a program, and 2 months ago, or 3 months ago, conventional was a better option than the FHA. But things change.
FHA.
Things change.
Yes.
And we would be honestly telling you a totally different thing like 6 months ago, because the market was different and the loan programs were different, and all the changes that we watch on daily basis and that we have to stay on top of, they do change the picture for our clients. And that's why it is important to sit down, to talk to your loan officer, to talk to your real estate professional, and understand what is going on in the current market, and how do you, particularly you with your situation, with your financials, can take advantage of this market. And believe me, guys, even when you think that 7.5% interest rate is scary, yes, it is very scary. If we look into the long term and we look into the graph of the interest rates through the last 40 to 50 years, you can see that the interest rates in this country have been up to 12 to even 18%.
18%. Yeah, some of the elders at the church told me 18%.
18%.
Back in, early 70s.
It was 78 through 81. 78 through 81. The rates were anywhere between 16 to 18%. And I do have, I'm blessed to have my clients who's been, who's been around. And when I asked them, what was your first interest rate, when you first purchased the house? And I've heard the numbers like 9%, 9.7, 12%. And that's why when they were buying and they heard the interest rate of 6%, they're like, okay, not a big deal. We've been there, they've been through it. They know that the moment the interest rate is going to go down, they're going to refinance. They already know the game.
I guess I could, now that you mention, I could sort of draw parallels that if someone's bought a home in the past, if they've seen 8%, 11%, whatever, rates really don't bother them so much. When I speak with them, and I'm like, oh, it's 7.5%, like, it's okay, David, we're going to refinance. We know this. We've been through these cycles before, right? Someone's young enough that all they remember is COVID. They're like, they get this shock, this paralysis. Oh my God, 7.5%. It's not 2.5% anymore. So yeah, it's interesting how generations, the experience of generations shows you different responses.
David, I've been in this business for over 11 years, and when I bought one of my homes, when I first financed a mortgage in 2015, I had a 4% interest rate, and that 4% interest rate, that was the best interest rate that I've seen in year of 2015. I swear I got the best interest rate of all of my clients. I was the one with the best interest rate. And, I thought for a moment that in my lifetime it's never going to get better. And when I had the different calls coming through offering me to refinance, I was laughing at people and saying, I'm at 4%, you can make it better. And then the pandemic came, and I'm like, oh, I proved myself wrong. I actually can make it better. And
you can do better.
Yes. And I
Yeah.
made it better, you know, like not only I made it better interest rate wise, I also, you know, like I also cut my mortgage time in half. You know, like I refinanced not only for the lower interest rate, but also for a 15-year mortgage versus 15 years. That's one thing. And another thing that, and my mortgage payment still went down, you know, so.
Yeah.
So it's the matter of time. It's the matter of time, and it's the matter of patience. And of course, you know, like the only thing that I can say is that sit down and look at a piece of, like put it down on a piece of paper. If, let's say, if you have to stay in this higher mortgage rate for a year, for 2 years, for 3 years, what it's going to cost you, how much you're going to save in equity, how much you're going to gain in equity, and
Right.
also talk to your real estate professional on how much of a discount, of a purchase discount, or how much of a seller's contribution you can get while purchasing and working in this market, while shopping in this market. Because when you put these numbers on a piece of paper, and you and I, David, have a client right now who actually realized that, and we just had a wonderful conversation with her, and she said that if it wouldn't be for you breaking down the numbers for her, she would be renting. She would be renting, and she would feel like she lost close to $18,000 in a year. And now she's entering into the house, and she is going to pay this $18,000 a year, but she's going to pay it for her home, not for somebody else's home.
Correct.
Thank you so much.
Thank you so much, Alexandra.
Thank you, David, and thank you for your time and your input. And guys, we're always here for you. DM us, contact us. Our contact information is always saved below this video. We're here to help you out and answer all of your questions.
Thank you, Alexandra.
Thank you, guys. Have a great week.
Have a great day. Yep. Talk to you later.
Bye.